Let's dive in. Think about this for a second. In your entire lifetime, how much money has actually gone through your hands? Every paycheck, every bonus, everything. Could be hundreds of thousands. Millions, maybe. Now, the real question is, how much is left in your wallet or your bank account right now? And if that number doesn't feel, well, satisfying, if you feel like you've handled a lot but don't have much to show for it, it might just be because you haven't really learned how to play what our source calls the money game. So today we're going to do a deep dive into 20 fundamental rules. These come from hard-won experience, lots of mistakes apparently, all designed to help you get much, much better at this game.
And I think framing it as a game is so important. This deep dive, it's like getting a shortcut, really. Understanding these principles of wealth that honestly are often misunderstood. These aren't just, vague ideas. They're actionable rules, like learning chess or even Monopoly. You learn the rules, you practice, and suddenly this whole complex thing about money feels, well, more accessible. It's actually empowering when you see it that way.
Okay, so let's jump right into rule number one, the foundation. Money is a game. Simple as that. And like any game, it can be learned. It's not about being inherently smart or just good with money naturally. No, it's about putting in the effort. Dedicated learning, practice. The more you play, the better you get.
That's such a crucial starting point because this rule immediately reframes the whole thing, doesn't it? It shifts your thinking from wealth being some fixed thing or only for certain people to seeing it as a skill you can develop. And that helps break down those limiting beliefs people carry around. I'm just not a money person. This rule says nonsense. It's attainable through, deliberate effort, not just luck.
Exactly. And building right on that, rule number two is a big one. Don't be a hater of money. Don't resent it. Sounds maybe a bit obvious, but the source really emphasizes this. Money flows towards people who embrace it, who appreciate it, not those who resent it.
Yeah.
There's this great dating analogy in the material. Like, if you constantly criticize someone, tell them everything that's wrong with them or people like them, they're not going to stick around, right?
Yeah.
It's the same with money. If you're always saying stuff like, money doesn't grow on trees, you're constantly critical of wealthy people, you're basically pushing money away. It goes where it's welcomed, where its potential is seen.
Yeah, and psychologically, this taps into some deep-seated barriers. If your internal story, your narrative, is negative about money or people who have a lot of it, that often becomes a self-fulfilling prophecy. You subconsciously sabotage yourself. It's really about getting your internal attitude aligned with what you say you want financially. You can't want wealth and despise it at the same time.
Which leads perfectly into rule number three, seduction. This one's really interesting. The idea is that money likes to be seduced, not desperately chased after. It's attracted to competence, to people who know what they're doing. Smart investors, strategic thinkers. It's not drawn to desperation or people just trying to show off. And the key distinction the source makes is crucial. You seduce money. Money doesn't seduce you. It's when you show you understand how to manage it, grow it, leverage it. Then it starts coming your way.
That really makes you think about how we pursue wealth, doesn't it? Is it this frantic, desperate grab driven by immediate need or wanting to look good? Or is it more thoughtful? An informed engagement that money, like a discerning partner, actually finds attractive. It's about competence and strategy, not just pure wanting. How do you think people usually fall into that desperate chase mode?
Well, I think it often stems from a lack of knowledge, maybe, or just a really short-term focus, wanting things now instead of building strategically. Okay, so we've set the mindset stage. Now let's get into the playbook, the strategies. Rule number four is powerful. It's a doubles game. The core idea is that the entire game of money boils down to doubling your capital. Think about this. If you have, say, $1,000 right now, you're only 10 doubles away from $1 million, just 10. If you're already sitting on $100,000, you're maybe 3-4 doubles away. It just makes these huge, intimidating goals seem way more manageable, step by step.
Right, breaking it down is key. But what's often missed here is how your personal situation shapes this doubling game. Two big factors the source points out. Your risk tolerance, which, usually changes as you get older. A 65-year-old probably plays differently than a 22-year-old. And your time horizon, are you aiming for that million in 10 years or 30? So this rule forces you to think about those doubles and be really self-aware about your own risk appetite and timeline.
That's a great point. How you pursue those doubles depends entirely on that. For someone young, maybe higher risk, a double could be an aggressive investment in a startup or really focusing a portfolio. For someone else, maybe it's aggressively paying down high-interest debt. That's a guaranteed return, right? Or pouring profits back into scaling a business they already know works. Okay, rule number 5, timing. Now, this isn't what most people think. It's not about like perfectly timing the stock market or jumping on the next hot IPO. No, this is about strategic business timing. Knowing when to double down on your business, maybe expand, even if, logically, maybe you should be cutting back. The source gives this example where the speaker expanded his business, hired people, when everyone else was saying cut, but he had inside info. And conversely, knowing when to tighten the belt, cut expenses, even if the sales numbers look good because you have some deeper insight.
Yeah, that highlights this interesting mix of looking at the numbers, the quantitative stuff, but also having this intuitive feel, foresight.
Yeah.
And the source is pretty clear. This kind of timing, you mostly learn it through experience. It's not really something you can get from a textbook. It's about really knowing the pulse of your own operation. But for our listeners, maybe they don't own a business. How can they start developing that kind of intuition in their personal finances?
Good question. I think it starts with really, really studying your own cash flow, knowing where every dollar goes, and staying plugged into trends in your industry or areas you invest in, not just reacting to headlines. Okay, rule number 6, boredom. Money hates being bored. It needs to be moving, working for you constantly. The analogy uses like a relationship partner. If they get bored, they're likely to leave. It's the same with money. If it's just sitting there, idle in a checking account, doing absolutely nothing, it'll somehow find its way to someone who does know how to put it to work. You got to keep it active, keep it generating more.
Practically speaking, that just means seeing money as this dynamic thing, right? Not static. If it stagnates, it loses its potential. For someone starting out, maybe that just means making sure it's in a high-yield savings or a simple index fund, not just sitting there. For someone with more capital, it's exploring different investments, maybe business opportunities. But the core idea is no idle cash. 0.
Right. Next, rule 7, leverage. And we hear this word a lot, usually meaning debt. But this rule broadens it out. It's about strategically boosting efficiency, boosting output across your entire financial life. Leveraging your business for more support, better sales, smarter marketing, faster growth. It's asking, how can I use what I already have to get more?
Exactly. And what's often misunderstood is that leverage isn't just financial. It's a broader concept. You can leverage technology, right? Automate things, leverage your network, get referrals, insights, even leverage your time by delegating stuff that isn't the best use of your skills. It's fundamentally about getting more output for less input. That's how you accelerate wealth creation.
Okay, let's shift gears a bit now. Talking about protection, being prudent. Rule number 8, the secret account. This is quite specific. An account that absolutely nobody else knows about. Not your spouse, not your business partner, nobody. And it's different from your standard emergency fund. The source tells this story. His company's main account was down to like $13,000. They were literally days from shutting down. What saved them? This secret crisis account he'd been quietly funding. It's like your ultimate hidden backstop for really severe, unforeseen stuff.
Wow. That really underscores the need for resilience beyond just the usual advice, doesn't it? It's advocating for a truly, truly independent safety net, a final line of defense when things go completely sideways and maybe other funds are tied up or gone. It's about ultimate self-reliance when chaos hits.
Okay, rule number 9, and this one always gets a reaction. Don't fly first class until you have $10 million in the bank. Now, the point here is about serious frugality and reinvestment. The speaker, apparently quite tall, like 6'4", 6'5", successful, said he has never paid for first class himself. Either someone else pays or he uses miles, and he breaks down the opportunity cost. That extra $1,500 or whatever per flight saved over many flights that could pay for employees, marketing, business expansion. It's about consciously choosing growth over comfort, especially early on.
It's such a concrete example, isn't it? A really tangible illustration of opportunity cost and how those seemingly small luxuries, when you add them up, can seriously derail your long-term wealth building. It connects directly to that idea of delayed gratification, valuing investment over consumption, especially when you're in that critical building phase. That's a tough one for a lot of people in our culture, I think.
Oh, absolutely. Instant gratification is everywhere. Which brings us to rule 10. Big check syndrome. This is a classic trap. You get a large, infrequent payment, maybe a big commission, $100 from a real estate deal, something like that, and you start treating it like it's your new monthly income, which it isn't. This leads to, well, arrogance sometimes and burning through the cash way too fast, and boom, you're right back where you started in your doubles game. There's this thought experiment. Would you take $500,000 lump sum now or $100,000 a year for 20 years? That's $2 million total. The source argues that the income stream, even though it looks smaller up front, gives you way stronger footing for bigger moves, more doubles over the long haul.
Yeah, it really hammers home the value of sustainable financial thinking versus just chasing windfalls. Connecting it back, it's about understanding the real power of consistent, predictable income streams compared to those big, isolated payouts, especially for long-term accumulation. That lump sum feels great, sure, but the steady income often has more strategic compounding power behind it.
Okay, shifting focus again. Navigating the outside world. Rule 11, your comp plan, meaning taxes. The idea here is that your country's tax system is your compensation plan. You absolutely have to study it. Using the U.S. as an example, the system often gives breaks to business owners, right? Incentives for creating jobs. So the insight is pretty direct. If the system rewards business owners, maybe you should figure out how to become one.
That's a fascinating way to look at it, viewing tax codes not just as, something you have to pay, but as dynamic systems, rules of the game. And once you understand those rules, you can position yourself strategically. Knowing how the government incentivizes certain actions lets you play the game smarter, not just get played by it.
Right. Rule 12 is one we see played out constantly. The end-of-the-world mentality. Think about the news, financial pundits. Often, crisis sells, right? Gets clicks, gets viewers. But that can create widespread panic. Like in 2008, people freaked out, pulled their money out of the market, and missed huge gains later on. Compounding, gone. The source says, look, if it's really the end of the world, like nuclear war, money's irrelevant anyway. But short of that, crises are actually massive opportunities for people holding cash. Everything goes on sale. Art, real estate, stocks. Huge discounts. The key is being ready, financially and mentally, for those downturns when they inevitably come.
It really calls for developing that mental strength, doesn't it, to act against the herd mentality, against the panic, recognizing that the best opportunities often pop up precisely when fear is rampant. It's about critical thinking, keeping that long-term view and not letting fear drive your decisions, having the courage to buy when everyone else is desperately selling.
And closely related, Rule 13. Study your politician's president. Now, this isn't about picking political sides. It's about understanding their underlying philosophies, especially on things like taxes. Do they lean towards heavy taxing or tax cuts? Because that directly impacts your financial strategy. The source suggests, for instance, if taxes are being cut, that might be a really good time to start a business. Make your money then. It's about adjusting your sales based on the prevailing economic winds they tend to create.
Yeah, from a bigger picture view, it just highlights how much those political decisions affect your personal financial planning. You need to be adaptable, ready to adjust your strategy based on the shifts in the broader political and economic landscape. Ignoring it is like, well, trying to play chess without knowing if the rules about how the knight moves might change next turn.
Okay, let's bring it back to your personal game and relationships. Rule 14. Study smart investors, but don't be too religious about them. Absolutely. Read everything you can from guys like Warren Buffett. Understand how they think. Why does Buffett avoid tech, for example? Get inside their mindset. But, and this is key, respect their philosophy, learn from it, but don't just blindly copycat them. Their game, their circumstances, their risk tolerance, it might be totally different from yours.
That's such a crucial balance, isn't it? Learning from the giants, soaking up the principles, but then making sure you cultivate your own financial perspective tailored to you. What's a common mistake you see when people get too religious about following a famous investor?
Oh, they often try to mimic the exact stock picks, maybe. Or follow a strategy without grasping the why behind it, or realizing that investor has advantages they don't. Leads to trouble, which flows right into Rule 15. Play your game. Don't compare. This is so important. Stop comparing your financial journey, your doubles game, to anyone else's, your cousin, your best friend, that guy on Instagram. Comparison is toxic. It often leads to making stupid, reckless decisions trying to keep up, and you end up losing doubles. No, you focus entirely on your game, your unique strategy, your timeline, your risk level. Play according to your vision, whether that's hitting $2 million or aiming for $1 billion. It's your scoreboard.
Absolutely fundamental. Keeping that focus on your own goals, your own path, and just turning out the noise. It reinforces that finance is deeply personal, your race, your pace. It's the only way to stay strategic and avoid those comparison-driven missteps.
Couldn't agree more. And related to that, Rule 16, beat your goals. Not just the index. So many financial advisors or articles talk about beating the S&P 500 or whatever index, but the source argues that's secondary. What really matters are your personal financial goals and the deadlines you've set for them. Especially if you're in business, you have way more control over how fast you grow your income, how fast you double your money compared to just passively hoping the index goes up. Your commitment is to your goals, not some arbitrary external benchmark.
Yeah, that really shifts the definition of success, doesn't it? From looking outward at external benchmarks to looking inward at your own self-defined goals, it encourages a much more proactive stance on wealth creation, focusing on the things you can actually influence and control directly. Makes sense.
Okay, Rule 17, befriend moneymakers. Simple idea. Association is powerful. The source basically says, hang around people who know how to make money, and chances are you'll start making more money too. Yeah, kind of rubs off. Now, practically, this translates into advice like, hire very slowly, fire very fast, be careful who you bring into your circle, and especially with potential business partners. Vet them like crazy, travel with them, meet their family, watch how they handle themselves, their discipline, before you tie your finances together. Trust is everything.
It's fascinating how much emphasis is put on the human element, the relationships, strategic alliances. It shows how the right connections built on real trust and due diligence can be massive catalysts for financial growth. But, for someone listening who thinks, okay, but how do I even start meeting moneymakers? What's like the first practical step?
Yeah, good question. Often it's about intentionally putting yourself in the right environments. Industry conferences, maybe specific online groups, workshops, educational programs, and maybe focusing on providing value first, not just asking for something. Okay, Rule 18. Now, the title of this one in the source material is deliberately provocative, designed to make you pause. Diversification is for absolute sissies, but let's unpack that carefully. It means diversification is for preservers of wealth, not necessarily for aggressive wealth creators. Here's the distinction the source makes. If you're actively trying to build significant wealth, you're in offensive mode. Relying only on broad diversification might make that doubling process way too slow. Could take decades. Now, it explicitly says diversification is the right move for people who've already hit their number. The person with $6 million at age 62 or 73, their risk tolerance is lower, time horizon shorter, they're playing defense, preserving.
Okay, so it's all about context. It raises that crucial question of tailoring your strategy to your life stage and your primary objective right now. Are you in the accumulation phase where maybe more focused, concentrated effort is needed to build wealth quickly? Or are you in the preservation phase where protecting what you have through diversification becomes the priority? It's not saying diversification is bad universally, just maybe not the fastest tool for initial aggressive wealth creation. Context is key.
Exactly. Rule 19, positioning. This is about deliberately placing yourself where you can get equity, get ownership in things that are growing. That's how the really big wealth gets built, often beyond just earning a salary. Think about having a piece of a company that goes public, like the example given about the speaker's president. It's about who you align with, making sure you're positioned to get ownership, not just wages. You want that upside potential.
Yeah, looking long term, it's about building actual value, actual ownership, not just trading your time for money indefinitely. Strategic alignment, getting equity. That can dramatically speed up wealth creation because you're directly tied to the growth of something bigger. But for our listener, maybe someone who doesn't have easy access to startup equity deals, how can they start thinking about positioning themselves better?
Maybe it's about identifying a really high growth industry and becoming absolutely essential within it. Or even starting a side business that has real scaling potential, something that could attract investment or lead to ownership down the road. Okay, finally, Rule 20, strategic partnerships. This builds on befriending money makers, but it's more intentional. It's about actively creating alliances where multiple parties benefit financially, which increases the total value for everyone involved. The speaker mentioned partnerships with huge, multi-billion-dollar companies. The core idea: the more people win financially by working with you, the more business flows, the more value gets created. It's about making the pie bigger together. Win-win-win.
That's a powerful concept, how these collaborative ecosystems can just amplify results far beyond what any one person could do alone. Well-structured partnerships really do have this multiplicative effect on wealth generation. Proof that sometimes, yeah, the best way to grow your slice is to bake a much bigger pie with others.
Wow. Okay, so that's 20 rules. We've covered a lot of ground, from mindset shifts right through to specific strategies and even navigating relationships. It really reinforces that idea, doesn't it? Money isn't some mystery. It's a game. And like any game, it can be learned, practiced, and mastered.
Which really leads to the important question for you listening right now. Considering all these 20 rules we just went through, which one? Which single rule are you going to commit to really studying and, more importantly, applying starting today to shift your own financial game?
Yeah, take a moment and reflect on your own relationship with money. Which of these rules really hit home? Which one feels like your current approach? And maybe more importantly, which one feels like the biggest challenge? And maybe, just maybe, holds the greatest opportunity for your next big financial leap.